Taking a look at the market reaction when it comes to the latest CPI print, these Fed expectations clearly, even with internal concerns about a recession, about a potential credit risk of a credit crisis, they're still forging ahead with the likelihood of more hikes. Do you think market expectations are now well aligned?
I do think that, at least for the May meeting, the market expectations are well aligned. So we're still expecting 25 basis point increase. And even just after the CPI numbers, a number of Fed speakers reiterated the importance of maintaining a tight monetary policy in order to really cool inflation. I think the real question is, when will the Fed start to consider cutting rates? Because ultimately, again, the Fed's position right now is for the Fed rates to stay where it is, or where it will be after the May meeting for much of this year going into 2024. But if you look at futures market, if you look at OIS market, the market is starting to price in somewhere between 50 to 75 basis points of rate cuts by the end of this year, which I do think is a bit aggressive. So I think the key is going to be where the Fed will start to turn in terms of interest rate cuts, rather than where policy rates going to peak. I think we are very much approaching the end of the hiking cycle here.
So when you take a look, though, perhaps in the near term, still higher rates in the US, you're looking at potential risks for re-rating when it comes to some of these Asian valuations, and the broader weakness that we're seeing when it comes to growth, the South Korean trade numbers, for example, feeding into that picture. Are these the reasons why you find fixed income at this point more compelling than equities?
Well, I do think if you look at the US economic cycle, if we are approaching a recession, and I think we are, fixed income, whether it's government bonds or investment grade corporate credits, tends to perform better and provide more resilience. The risk for high yield, for example, is for spread widening, and that will impact on bond prices. And of course, for equities, valuation is still not particularly cheap, and I think earnings expectations is still too optimistic. So from that perspective, I do think the opportunity overall still favors fixed income at this point.
Tai, David here, does that sort of advice to recession-proof your portfolio also apply if your exposure is mainly Asia, where we might not actually feel the U.S. recession if it does come, of course?
Well, I think you've already seen some of that being reflected in Taiwan and South Korea as of last year. Obviously, Taiwan and South Korea outperformed in the first quarter, but if you look at, again, earnings expectations for 2023 continues to be really weak. So I think if you want to, so-called recession-proof your portfolio for Asian investors, China, some of the more domestically focused companies in Asia, I think those are better places to be. Ultimately, you have a China economy that is recovering. Obviously, we do want more engines to be firing up in the next few months. And meanwhile, policies in China continues to be accommodative. I think that's great news. But also, when you look at some of the Asian central banks, they are starting to pause. In fact, you've got Vietnam cutting rates. So I think, again, from a policy angle, I think Asian central banks have a bit more autonomy compared to previous cycles, even if the Fed does raise rates once more in May.
Right. And Tai, I was looking at the onshore market. Some indicators like turnover and margin debt have started to, I guess, in some ways come alive. Is that a precursor to some rally further down the road, if not soon?
I think so. I think it's not just about margin debt or some of these financial indicators, but also the fact that if we are starting to see consumption leading the way, and then fixed asset investments, from the total social financing numbers we saw, companies are starting to feel more optimistic about investing. The real estate sector stabilizing. I think these are all really important signals to indicate that the Chinese economy is on the mend. And that, to me, is going to be really important in terms of driving corporate earnings for China, which historically, once it started to outperform U.S. corporate earnings, the Chinese market tends to outperform the U.S. market.